All right, welcome everyone. This is Mir Pasha with the Mir Pasha Show. Let's start with the April CPI number. Consumer prices rose 3.8% year over year in April, and monthly that's a 0.6% gain. Now, core inflation, which strips out food and energy, the two things that you actually need to buy every day, came in at 2.8%. But the Fed's target is 2%. Now, the mainstream financial press will say that the number was largely driven by energy. And while that is true, energy costs surged 17.9% year over year. Gasoline is up 28%, and fuel oil is up 54%. They're not telling you the whole story because shelter inflation is still running at 3.3%, and food is up 2.3%. And as you know, those are not just energy prices. Now, the bond market is saying the same thing because the 10-year treasury yield spiked after the CPI print, and markets are now pricing in zero rate cuts through the end of 2026. And some investors are even starting to price in actual rate hikes before the year end. Now, I'm going to speak on that in a moment, but the press is treating the April Fed vote like some kind of a suspenseful drama where there were four dissenters and the most divided committee since 1992, and it was Hawks versus Doves, and nobody agrees. But don't get distracted by the theater. And so ask yourself, why would Trump go through all that trouble to get rid of someone like Jerome Powell just so someone like Kevin Warsh could come in only to increase interest rates again? And the answer is that he wouldn't, right? As we know that Trump not only publicly humiliated Jerome Powell in press briefings on his Truth social media posts, but he also threatened to sue him. He started a legal case against Jerome Powell on some BS charges just so he could pressure Jerome Powell into not increasing interest rates and into resigning actually. So now we have this guy, Kevin Warsh, and he's chosen Kevin Warsh. And if you're honest with yourself, you will understand that it's because he wants Kevin Warsh or someone like Kevin Warsh to come in and maybe decrease interest rates, but even if he doesn't, maintain interest rates where they are right now, because with inflation increasing, real interest rates are falling. So understand that Trump wants lower interest rates, Trump wants cheap money, and Trump wants a Fed that would finance his deficits without any complaints. So the vote split that you're reading about, where some officials want to cut, others want to sound tough, that's just noise. And the signal is what it's always been, that when the choice is between politically painful rate hikes and printing money, the government will always choose to print. That's what they have always done. And the only question is, how long can they pretend otherwise while inflation does what inflation does best? Which brings me to why inflation came in where it did, because you can't understand this week's economic picture without understanding what's happening in the Strait of Hormuz, and why this week's good news on that front isn't actually good news. The US Iran war that began in late February has effectively closed the Strait of Hormuz to commercial traffic. About 20% of the world's oil and liquefied natural gas normally flows through that narrow waterway. Since the war started, shipping has virtually halted. The IEA says roughly 14 million barrels a day are being blocked, and Saudi Arabia and the UAE have ramped up pipeline capacity to bypass the strait, but those pipelines don't come close to replacing what normally moves through the water. Oil peaked around $110 per barrel for Brent crude earlier this cycle. This week, there was a movement on peace talks, and Trump posted on Truth Social that negotiations were proceeding nicely, but it's all just BS. It's all market manipulation by Trump, as we have seen classic Trump market manipulation in the past, we have seen from him. And resultantly, it doesn't matter to investors what the reality is, because the investors come in running based on what Trump says on his Truth Social posts. And oil fell briefly below $90 for WTI on Monday, and the markets exhaled. Problem solved, right? Not quite. By Tuesday, fresh US military strikes in Iran pushed oil back above $92, and by Friday, Brent was back near $103. The two sides remain deadlocked over Iran's enriched uranium stockpile and over who controls the tolls on Strait of Hormuz, right? This is rich. Iran, because Iran wants to be paid for ships passing through its waters, and Washington says no. So we have a war in large part about who gets to charge a fee on an oil shipping lane, and the result is that the lane is now entirely closed, and gasoline in the United States is running about $1.50 above pre-war levels. Now, what is gold doing in all of this? Gold pulled back this week. It's trading about around $4,520 today, down from a peak of roughly $5,600 back in January. The mainstream take is that gold is retreating as peace talks progress. But look at the actual number. Gold is up 36% year over year, which means that if you had bought gold a year ago, you are significantly ahead of inflation. And the pullback from January's high is not gold rejecting the monetary thesis, it's gold catching its breath in the middle of a long term repricing. When the Iran situation resolves, or if it resolves, inflation will not fully resolve with it. Because the underlying monetary debasement that drove gold to those highs in the first place has not been unwound. And so the fiscal picture will make sure of that. And that brings me to the most important story of the week, one that got almost no coverage because there's no single dramatic event to point to it. It's not a rate decision, it's not an oil spike. It's a slow motion fiscal catastrophe that is now accelerating faster than at any point in American history. The US federal government will spend, get this, over $1 trillion this fiscal year just on interest payments on its existing debt. $1 trillion. Not on defense, not on social security, not on infrastructure, just servicing the interest on money that has already been spent. That number is projected to double to 2.1 trillion by 2036, but I'm suspecting it is probably going to be more than that. The national debt is now approaching $39 trillion, and the Congressional Budget Office says that the debt to GDP ratio is on track to exceed 120 or 120%, by the end of this year. For context, 3 consecutive credit rating agencies, including the S&P in 2011, Fitch in 2023, and Moody's just last year, have now downgraded US sovereign debt. America does not have a top tier credit rating at any of the major agencies. This means the country that owns the world's reserve currency cannot get a perfect credit score. Now, think about what that means. And instead of addressing any of this, Congress passed and the president signed the one big beautiful bill last July, which was a net spending increase. By the CBO's own analysis, that bill adds $3.4 trillion to the deficit over the next decade. It makes the tax cuts permanent and trims spending only modestly. The debt ceiling was raised by 5 trillion to accommodate it. And here's the part that should alarm everyone who has been told that the dollar is still strong. The dollar index, the DXY, is sitting around 99 right now. Under normal circumstances, an active military conflict in the Middle East would raise inflation, and global uncertainty would serve as rocket fuel for the dollar because the dollar has always been the traditional safe haven. Investors flee to it when the world looks dangerous. That's the textbook. However, instead, right now, the dollar is flat. It briefly hit a 6 week high last week, and people celebrated that. A 6 week high. When you should be seeing multi year highs in this kind of geopolitical environment. Goldman Sachs is forecasting that the DXY will be in its low 90s by the fourth quarter. Markets are quietly, steadily diversifying away from the US assets, not in a panic, but consistently month over month. Now, that is not the behavior of a world that believes that the dollar reserve status is secure.